share my screen. Okay, can you guys see my presentation?
Yep.
Yep.
All righty. I cannot see you while this is going. I can make this larger if need be, or is it adequate as it is?
I would make it presentation mode.
All right.
Yeah.
There you go. Okay. This says options for beginners. In reality, there's another place in here that says advanced options. We're just going to go through the whole thing. We have a mix of experience in this class. There are some people that are new to trading overall, and therefore will be new to options. And then a lot of you guys have been doing this for a long time, some of you professionally. 2 rules for options trading, and they're listed at the bottom of every single one of these pages. 2 big rules. You violate these 2 rules, you will lose money. First one is don't be a pig. And what we mean by don't be a pig, after you've had a little bit of success with trading options, you tend to feel a little bit invincible, and you tend to push it a little bit and think, well, geez, I made this much money, I can make more. And then if you're successful making more, then you do it again, and you do it again, and you do it again. And then eventually you lose far more than you ever made because you were a pig. Don't be a pig. Trading options often, not always, but often deals with margin. You have to manage your margin. We'll talk a little bit about that as well as we go along. But staying in good graces with your broker from a margin point of view keeps you from having a cascading loss, something that's uncontrolled. Again, we'll discuss that a little bit later. But for today, those are the 2 big things to always remember. Don't be a pig, and to manage your margin. My goals for this class, basically, you're here because you want to make options a bigger part of your toolbox. It's not to replace your toolbox, it's just to add to it. There are points in time, if you trade options every single day like I do, then there are periods of time in which you can figure out when to push it, and other times that you want to be a little bit more conservative. There are times that selling calls might make sense, other times that they don't. We'll go through that. Other things that should be goals for this class: learning the terminology. Options has its own terminology. We have things like strike prices and underlyings and volatility regimes and all kinds of different things. Learning the terminology allows you to actually speak with somebody, another human being, and both of you have the same understanding of what it is that we're talking through. I publish data every single day, every trading day, I guess, in the data channel under Slay Trader. One of my goals is to get you to understand what that is. This class starts slow and steadily ramps up to getting fairly complicated by the time we're done. And there'll be little breaks in between each section to where you can ask questions. That's really the good time to ask it. So if you get lost on a section, ask your questions once we've finished, because I may answer it somewhere in the other part of the section. Mathematics are a part of options. I can't stop that. And there was some calculus. There's a lot of statistics, but we don't want to get bogged down in those kind of things in the class. But again, having some background in statistics or probability is not a bad thing. People that make good options traders are really, really good at things like fantasy football, gambling, sports betting. If you're good at that, you'll be good at options trading as well. Bill, what else am I missing? You and Kim have a lot of experience with this stuff. What else should we be talking about here?
Oh, I'll volunteer this. The other thing too, which if you're relatively new to this too, in advance, forgive yourself. You're going to make mistakes. You're going to lose money. I lose a lot of money too. All of us who've been through this for a long time, you have to get used to, and especially if you have a gambling personality, you're going to want to jump in right away and win it back. I can speak from experience. I have a little bit of success trying to recover on a day trade. That's short term. Long term, I lose money. You take your loss, you move on. And this goes into the two principles which Peter's going to hammer home again and again. Don't be a pig and manage your margin. And then the other thing too is, and this is cliche, and if you're into AI, it's going to tell you this too. Just remember, sometimes not making a trade is the best trade of all. And I'm going to back off.
I think Phil would tell you that as well.
You're damn right.
Um,
And I have all the engines and everything built on data and math that explicitly point out to the wisdom Kim just talked about. Yes. Some days you just can't make a trade.
Well, I trade every day, so I go the opposite direction of that, but it's a little bit different.
You're in that 1%er club.
Well, I also have stop losses, but we'll get through all of that. So
I think that actually I would emphasize that, and it's really something that. And Peter, I go over my data with you in details that it was amazing to me when I did all the back testing. It showed stop losses and having a plan to get out early is the difference between being the casino and making money long term versus losing money. It was surprising to me how clear the math and data showed that if you don't have an exit strategy, chances are over the long run you're gonna lose money. So I don't know, Peter, maybe I'm emphasizing that too much, but
no,
it was the data said it.
Basically, there's an old rule that when you trade, you need to have a plan, and you trade your plan. And part of the plan is when to get out, when to give up on the trade, and that's essentially all you're talking about. I don't care whether it's an option or futures or anything. You need to have a thought on when you take your loss and just get out and don't look back. It's the way it is. Yep. So let's discuss what an option is. Okay. I'll read the top part. An option is a financial contract giving the buyer the right, but not the obligation to buy or sell a security at a predetermined price on or sometimes before a predetermined date. To gain this right, the buyer pays a premium to the contract seller. Okay. And there are two kinds of options. There are calls that give you the right to buy the security at a predetermined price, and there are puts, which are options to provide the right to sell the security at a predetermined price. The yellow box at the bottom is really the apt example. Most of us know what term insurance is. We have term life insurance, we have term homeowners insurance, we have term car insurance. In most cases, you are the buyer of that insurance, and it expires at a certain date in the future, and you pay a premium, oftentimes each month. For an option, you can either be the buyer of the insurance or the seller. Okay. I spend most of my time talking about selling here, and most of my data is regarding selling of options, not buying them. On occasion, we have to buy options to manage our margin, right down here, and sometimes simply for speculation. But the strategy is basically to sell insurance that is unlikely to be exercised against you to generally a market maker, not another individual. You trade options against a market maker. So this is what an option is. Think of it like insurance. What are the characteristics of an option? Well, there's something called an underlying asset. The underlying asset is simply the stock symbol. SPX is the underlying asset for S&P 500 options. There are options for individual stocks and ETFs and a variety of other financial instruments, and we'll get a little bit more into that. Calls versus puts, we kind of talked a little bit about. Contract size, we'll get into. Expiration date is similar to what it is for term insurance. It's a point in time in the future that the option no longer provides the protection, or if you're the seller, you get all of your money. Strike price, we will go into a little bit later, but that's essentially where the option either pays the buyer or it expires at zero. Premium is what you pay, what the buyer pays to own the option, and it's what the seller receives to provide the protection in the contract. There are two types of exercise styles. We'll go into those a little bit later, and then there's different ways that these settle. Okay, and that's going to be important too. We'll go into that. The underlying asset, we kind of talked a little bit about this. Underlying assets, common stocks, indices, futures, bonds, interest rates, currencies, and ETFs. So again, options are available for, I don't know if options are available for crypto. Does anybody on this thread know that? I know you can get them for the ETFs on crypto, but what about Bitcoin? Does it have options yet?
There are some ways of trading options for crypto, but I don't remember exactly what the site is. It's something like the Polymarket stuff.
Oh, okay. That might be. So it's not exchange related. Yeah, I don't know of a way to do it through an exchange, which is probably kind of important. So that makes the option kind of a little bit different outside of your portfolio. But at any rate, just realize that there are options available for all kinds of different financial instruments. Calls and puts. We went through this a little bit. The call option gives the buyer the right, but not the obligation to buy the underlying asset at a given strike price. Okay. Put gives the buyer the right, but not the obligation to sell the underlying asset at the strike price. This table here kind of gives you what the various options are if you're a call buyer or seller, or a call put, or a put buyer or seller. Let's give you kind of an example. Let's say you have a stock that is currently trading at $100, and you want to buy a put against that stock because you have it. So you want to buy insurance. And let's say you buy that insurance at a strike price of 95, okay? Which means that if the stock falls below the strike price at expiration of the put, okay, then you get the ability to sell that put for the value of $95. So let's go through this example. The stock is currently trading at $100. I want to buy a put at $95, so I'm willing to take $5 worth of loss on it. And in order to do that, I need to pay, let's say, what would be maybe 10 cents. Okay. So to get that kind of protection, I need to pay the premium of we're going to call it 10 cents here. And we'll just use the contract size of 1, just to make the example simple. So if the stock price falls to say $90 at the time of expiration, the put will automatically exercise, and you will receive $90 and lose one of those one share of that particular symbol that you had bought for. So you'll save yourself $5 or $4.90 when you include the premium. which is why buyers buy that. If you're the seller, you are obligated to actually buy that that stock at the price of the strike price, but you receive 10 cents for it. Okay, it's kind of how this works, and that's what the table is trying to say here. Excuse me. Contract size. When you trade options, the standard contract size is 100. Okay, so the premium is expressed in terms of 1, but you have to multiply it by 100 to know how many actual dollars are going in or out of your account. Okay. Not all contract sizes are necessarily 100, so it's important to know what the contract size is before you enter into the contract, because I have seen people make mistakes with that, where perhaps the contract size was actually 1,000. They didn't realize it, which is 10 times larger than what they thought it was going to end up being, which meant that they were an accidental pig, because they didn't realize that the contract size was a little larger than what the standard contract size was. If you're trading stock options on stocks and indices, and the exchange is the Chicago Board of Options Exchange, the CBOE. The standard contract size is 100 unless it's otherwise specified. You usually don't have to worry about this. Just think of it as 100. But if you don't know, it's worth looking up. Expiration date. Just like term insurance, an option has a limited lifespan, and they expire. If you're short the option, expiration date is the guaranteed day at which you either made or lost money on it, depending upon what your strike price was. But after expiration, that particular contract can no longer be traded. There's a term called in the money and out of the money. In the money means that the contract has value. If it expires in the money, that means that the buyer is collecting and the seller is paying either through an exchange of stock or an exchange of money, one way or another. And we'll get a little bit more into that. That gets down into settlement type. Strike price. We went through this a little bit, but the strike price is the predetermined price at which, upon settlement, the option will either be in the money or out of the money. There are a variety, hundreds. In terms of, in the case of SPX, there are hundreds, if not thousands, of different combinations of strike price and expiration for S&P 500 options at any point on any given trading day. They go out years, or in some cases, like Kim was talking about, options that expire on that particular trading day. Those go out, I think 5 weeks or something like that. But at any rate, strike price is the point at which it is determined, or strike price is the point at which the insurance contract either will pay you at expiration or expire at zero. If you're a seller, you want to choose your strike price so that it expires at zero. And almost all of my work is done to find that particular strike price. Premium. Just like an insurance contract, if you buy an insurance contract, you pay a premium to the seller. Options are no different. Premium is the price of the options. The premium varies based upon where the underlying asset, what the underlying asset value is relative to the strike price. Depends upon volatility. And it depends upon time. Okay. Here in Florida, we did a very popular type of insurance is wind insurance for hurricanes. Okay. Wind insurance is starting to get to be more expensive. If you haven't already bought it for your property by now, you are paying more for wind insurance now than what you might have in late January. Rationale is that hurricane season is about a month and a half away. And that's when the odds are higher that you're going to be able to collect on your wind insurance. That's sort of like the underlying asset getting closer to the strike price of your option. Doesn't mean that it's going to happen, but the odds are higher that you're going to be able to collect on that insurance, on that wind insurance, because the odds are higher that you're going to have a wind event. Just like if the underlying asset moves towards the strike price of your option, the premium will go up. American style and European style exercise. One thing that you got to, that it's kind of easy to remember here, American style exercise can be exercised at any time during the option's life. Okay, that's the one thing to note. European style options only expire at expiration. I personally prefer European style options for that reason as a seller, because I don't want to accidentally come in one day and own stock that I never really wanted under an American style options exercise. In general, stocks, say Apple or Nvidia or any kind of stock like that, is an American style exercise. I believe SPY options are American style exercise, as opposed to indices. Like SPX is a European style exercise. I believe that RUT, the Russell 2000, is also European, and I believe that NDX, the NASDAQ 100, is also European. Okay. When you enter into your contract, it's kind of important to know which style that you have, just simply because you need to be prepared to potentially own the stock if before expiration, if it's an American style option. Settlement types. Options that expire in the money. So first of all, let's talk about options that expire out of the money. Options that expire out of the money expire at zero value. There is no exchange of either stock or cash for that. Okay. If the option expires in the money, then there is a settlement either in cash or in underlying shares. Stocks and ETFs are generally settled in shares of the underlying. And we go through what happens here for those various options for calls and puts. Basically, you either the buyer has the right to force an expiration or force a purchase or sale of their shares of stock based upon how many options that they own upon the seller of the option here. Okay. The option seller for an option that expires in the money has no recourse. They have to do it regardless of what else is going on. Okay. Futures and indices are cash settled. So like something like the S&P 500, you simply lose money there because the index has there's no underlying shares for it. It's just all of it's cash settled. Basically, it's 100 times the number of options times the difference between the closing value of the index and the strike price. That's what the cash value is equal to. Any questions so far? If you're new to options, we've already covered a reasonable amount of material. All right, let's keep going. Pricing. Welcome to your beginning of mathematics. Option pricings for securities can be determined by the Black-Scholes. It's actually Black-Scholes Merton pricing model. I just pulled this from Investopedia. This is the pricing model for a call option right here. Okay. Each of these are, the ends here are a standard normal distribution of this value, where you've got a natural rhythm and a number of other things. I don't want you to get too caught up in this mathematics. We'll go through what all of this actually kind of means. But let's talk about the elements of it. Current stock price, okay, that's the underlying price. Okay, that's right there. The strike price, okay, is right here. The risk-free interest rate, right here. Time to maturity, T, right here and here. I already talked about this being the standard normal. And then we have a value, that sigma value right there. Does anybody want to tell me what the sigma value is? Phil, I know you know what it is.
Oops, there's the
Deviation.
button. Yeah, standard deviation.
It's a standard deviation of the stock price. So basically this value right here is the standard deviation of the stock price, which is the realized volatility. Okay. In the Black-Scholes Merton model, the standard deviation right here is often varied by the market maker. They have control over what is put into that equation, and that turns that value into implied volatility. Okay, actually.
Can you verbally,
Right
I think that's an important point, and I see that a lot, and it's not straightforward, so to speak. The relationship between IV, implied volatility, and realized volatility.
Implied volatility is what the volatility of the stock is, is what is implied by the price of the option to the stock. Okay, so you have realized volatility right down here as part of the equation, and then up here is implied volatility. This value, and that is set by a market maker. We've had some crazy market action here recently in Avis rental car. Avis rental car went and GME'd itself here over the course of the past month, and it was trading at one point in time at $780. I believe it closed here recently at below 180. So it lost $600 in its stock price. But there's no reason why Avis rental car should even be trading at $180. It's still overpriced, but it went and mooned. Option prices on that blew way up, and most of it was because of this particular value right here, the implied volatility in the stock and the realized volatility in the stock. Market makers control the implied volatility. If they want you to stop buying options because their book is overloaded in one direction or another, what do? It's the easiest thing that they could go do. They want you to stop buying.
Raise prices, supply and
They
demand.
raise the price. So let's see. Can they change the current value of the stock price? No. Can they change the strike price? No. Do they have control over the risk-free interest rate? No. Do they have control over the time to maturity? Nope. The only value that they can change is implied volatility, and that's what they do. Okay. When we see a VIX spike, why does the VIX spike? Because option market makers raise the price of implied volatility. Right there. Again, they don't control the stock price. They don't control the strike price. They don't control the risk-free interest rate, and they can't control the time to maturity. The only thing that they can control is the value of implied volatility right there. Remember that. We'll be talking a lot about implied volatility, volatility in general. Volatility for an option seller is your enemy. Volatility for an option buyer is your friend. Okay? Let's keep going. Intrinsic value. Who wants to tell me what intrinsic value is? Kim, you know what intrinsic value is. It's intrinsic value. S&P 500, let me give you an example. The S&P 500 closed at 72.20 something on Friday. I don't remember what the exact number was. So if I had a call option at 7,200, what's the intrinsic value of that option?
The price?
Intrinsic value is the underlying asset value minus the strike price. So it's whatever it closed at on Friday, 72.20 something minus 7,200. And that value is $20 some, right? That's what it is for a call.
So what it is, it's the actual, what I was going to say is the worth of it. In other words, this is, or the calculated worth, right?
Think of intrinsic value as being what it would be worth if it expired at that moment.
It's a snapshot, right? It's just a snapshot.
Exactly. That's all it is. That's what, so when we talk about the intrinsic value of a strike price, it's either in the money or it's out of the money, right? And in the money intrinsic value of an option is simply the difference between the strike price and the underlying asset. And the math changes just a little bit between calls and puts. Okay. Notice that puts are insurance to the downside while calls are insurance to the upside. And that's reflected right here in this mathematics. For a call to expire in the money, the underlying asset value has to be greater than the strike price. For a put to expire in the money, the underlying asset value has to be less than the strike price. Okay. That's all it is when you write down to it. This is terminology that you may read in literature or whatnot. I don't use it a lot, but if you run across it, it's important to know what it actually is. Time value. Okay. Time value is the difference between the option premium and the intrinsic value. Okay, that's what is in the time value of the option. Time value is very important. All right. So if the option, let's take an example of a put option where the underlying asset is above the strike price. Okay, underlying asset is above the strike price. What is the intrinsic value of that option? Well, let's do some math. Underlying asset is above the strike price. Right here, 0. What is the time value of that option?
The delta.
A premium.
Yep.
A premium. Premium is the value you pay for the option. If the intrinsic value is 0, then the premium must be the time value. Okay. For an option seller, if you were selling options that are below the underlying asset, you are selling the time value of the option. Okay. On a call, if the strike price is above the underlying asset, again, you are selling the time value of the option. Okay. So time value is actually very important. Just remember it relative to the intrinsic value. Time decay. For an option seller, this is the most important chart that's on here. Phil, you know why. Why is this the most important chart for an option seller?
Defines well, it defines multiple things, right? But your profit basically.
Well, if you want to sell an option, if you want to sell an option, which of these time regimes is the best one to sell it in? You get most of the premium inside of 30 days,
Right.
right? You get most of your money inside 30 days.
Everything
So
I
if you
do
want
is
to sell,
30
if
or
you want
less.
to realize your gain, you want to usually sell options within 30 days of. So this is sort of talking about expiration here. We don't really want to sell options that are way out in the future. 120 days takes a long time for that premium to decay. Okay. In other words, you don't realize your gain, or you realize only 30% of your gain in 90 days of time. You realize the last 70% in the last 30. So selling options is usually best done within a month of the current date. Erosion of time value is called time decay. And this is a direct artifact from that equation that we had earlier, the Black-Scholes-Merton equation. So selling options, if you want to buy an option, oftentimes it's best to go out in the future. And the rationale being that you really don't want time decay working against you in that particular case. So in the thread, I'll talk about buying a long-term option, which is way out here on this graph. Because I'm usually buying stuff that's a year away, which means that as the days pass, I have very little time decay, but I get the value of the change in underlying asset value and volatility from that. Okay, but I sell down here. Time value and volatility. I've got an old example here. This is really old. MicroStrategy and Berkshire Hathaway. MicroStrategy isn't even called MicroStrategy anymore. It's strategy now. But this was an example of the time value versus the expected volatility of the underlying option. This is where we're starting to put together multiple different constraints on the option, if you will. Note time value versus implied volatility. That's the two things that we're gonna go look at together now. So you remember what the time value of the option was, right? So if the MSTR price is 421.88 and we're looking at a put option of 425 or let's just do let's do 400 for both cases. We'll do 400 here. The time value at $20 difference, okay, below it is $36. If we look at Berkshire Hathaway, that looks like what, 476. So let's go $20 below it. And that's 450. Its option price is only 7 cents. MSTR has an awful lot more time value in it because the stock price at that particular point in time was a lot more volatile. You see that? This is a chart that's easy to get lost in, or an example that's easy to get lost in, but it is fundamental. Everybody get the time value part? Why am I saying the time value in this 400 option right here is $36.05 for MSTR at 421? Let me ask it a different question. For a put, if the strike price is 400 and the underlying is 421, what is the intrinsic value? Zero. So if the intrinsic value is zero, the time value has to be the entire premium, right? Premium is equal to time value plus intrinsic value. Okay. What I don't have in here is what the implied volatility in that option price is. Maybe that's the one thing that's missing. But if you go look at it relative to Berkshire Hathaway, note that the time value is extraordinarily low with the intrinsic value. And Berkshire Hathaway stock does not move violently, as a general rule, relative to something like MicroStrategy, which is basically Bitcoin. At that time, this was basically Bitcoin. That was the way that you played options with Bitcoin. So volatility, it affects the time value of an option a lot. If you follow my thread, I always like selling options, and if you're ever going to be a pig, don't be a pig. But if you're ever going to be a pig when the VIX is really high, because then your time value of your option is also going to be really high, regardless of which way you go. Okay. Questions on this particular chart. This is an important chart.
No questions for me as of yet, but I just wanted to say that's really interesting. I haven't explored this component of and had little understanding, so I'm sure I will develop questions, but this is a great example between the two.
Well, this is important because you make your money selling options. You make your money when volatility is high, not when it's low.
Right.
And Phil won't even trade this. Phil wouldn't touch Berkshire Hathaway here, but he might MicroStrategy here. Okay. Interest rates. Interest rates do play a role in options, but they're really, really where the role that they play isn't in the short term. It's really for longer term options. If you go look at something that's 5 years out in the future for an option, there's going to be some interest rate effect for that because of the cost of money. But if we're looking at shorter term options, like on an option that expires within a week, there's really no interest rate impact whatsoever. If you go out a month, you wouldn't be likely to measure the interest rate impact in it. Maybe it's a penny, if that. It's so small it doesn't really make a lot of difference. But if you go out in time, then the interest rate can play some difference. But interest rates generally need to be pretty high before they impact the price of an option, and we haven't been in that kind of environment for years. Even in 2022, when interest rates were short-term interest rates were relatively high, they didn't really impact the price of an option that much. Just know that is one of the factors. Dividends. Stocks pay dividends. This can impact the price of an option because the dividend is implied in the price of the stock. The one thing I want you to know about the dividend is this is the yellow box below. Short and call options around the ex dividend date, you may find yourself short the underlying shares prior to that dividend date, and you owe the dividend. I don't remember how the arbitrage exactly works, but I've had this. I know this from experience. So be careful selling call options specifically at near an ex-dividend day. In fact, I would actually argue don't do it. It's not worth it. Questions so far? Thus far, these two sections that we've covered for a beginner, these are very important to understand. Especially this second section that we've gone through. The understanding the characteristics of an option and kind of how they work and the things that impact price and premium and what you're buying and selling is extraordinarily important before we go too much farther on. Anybody got what time it is? I can't see on my computer.
I've got 8 to 11.
Okay. This is
Only
not
a-
a bad time. This is not a bad time to wrap up, because I don't really want to start the next section and just rush through it. Any questions in general?
Peter, this is Jordan, aka Irish Fury, for those of you that see me in the Discord chat. I'm curious, you've kind of highlighted a few different things during our time here together, which was wonderful. I'm curious if you have almost a checklist that you go through or would go through before you actually execute a trade. You know, you look at obviously your slay trader output, you look at what the implied volatility is. Now you just raised the idea of dividends. I'm sure earnings would be also kind of in the mix. And so curious if you have a checklist or something to that effect.
I
Before you actually
don't have one available with me right now. Otherwise, I'd hold it up to the screen. I think if I was in my office, I would have one. Just a second.
And there's probably one we could even develop as a community to say, hey, you know, watch out for these things, but maybe handy.
I think that's
So-
a great idea, Jordan. You tell you
I
could-
trade options professionally, and I only trade SPX options professionally. But what I just dug out of the trash, and I don't
I was
know.
going
what
to say
date-
that paper looks
date
like
this
it's
was
seen better
for.
days.
Well, this was my trading sheet.
Hmm.
Okay, so I have, going into a day, I have a sheet that, in fact, I can tell you what day that was, for April 22nd. Okay, I have a sheet that lists off. This has expiration dates from April 22nd through June 12th. It's got various strike prices, tells me the days to expiration. It has a min price for what I'll sell the option for. It tells me what my AI numbers are. It tells me where never lost was. I've got all that sort of stuff that you guys see in the slay trader data, except
Mhm.
I have it comprised in one sheet. And I trade off this sheet. And there's a minimum price I have to get for the option. It also tells me where the optimal buyback price is and all kinds of other stuff like that. So to answer your question, yes. Yeah, I have that. I suggest that everyone have that. In addition to all of that, if things go pear-shaped in the market, I have on this sheet, it tells me what percentage of net liquidation value I'm willing to lose before I get out, before I liquidate the account. It's got all of that information on one sheet. That is my day's trading plan, is a way of thinking of it. And I trade my plan. I know Phil puts out his expected value stuff every single day, and he trades a lot of those expected values. That's sort of a trading plan. The things that are missing are where would you give up on the option,
Right.
buy it back and things like that.
Mhm.
But again, with SPX, I don't have to worry about a dividend. There is no dividend on the SPX index. I don't have to worry about this earnings or anything like that. Meta earnings might impact it, or Nvidia earnings might impact it, but I don't ever pay any attention to that. It's just one stock. It's not going to be as volatile as if you were trading that alone. Note in the slay trader data, if you look at the individual options, if there is an expiration that might be shortly after an earnings date, they're highlighted red. Okay, so I do highlight when an expiration might be shortly after an earnings, so that you can't get hurt that way. I don't do that with dividends. Dividends are something but dividends are often paid around the same time that an earnings is. SPY is the third Friday of every month that is evenly divisible by 3. So March, June, September, and December. That's when the SPY dividend comes out. So just know what those are for what you trade. Note that the price, what'll happen is the price will come down that much.
Mhm.
And if you're near, and for SPY, like the dividend is around $1.80, or 18 points in SPX. So if you're within, if your call option is say only 10 points
Yeah.
or is $1 above it, for the buyer, it's worth exercising that option on you, collecting making you short the option. He's no longer, if you sold it, he's no longer in the option, and he collects the $1.80 plus the extra $10 from you for it. So
I think if you want to get specifics to your point, Jordan, you could almost look at that equation, right? So Peter, you have a minimum price you're looking for. You have a duration DTE that you're looking for. You know, those
well, and until the price changes with the duration.
exactly. So you kind of have your, you know, speaking of a checklist, I mean, I kind of automate it all, but I have those,
Mhm.
you know, in my built into my model. So you definitely have them. And it depends on, you know, a little bit on what you're trying to do, right? There's general guidelines. I don't do anything beyond 30 days, to Peter's point earlier. I use expected value as a big driving factor because that's basically a casino play. You know, if there's an earnings date, I don't go out beyond an earnings date. So that immediately nullifies a trade. So, you know, there are definitely checklist items that,
Mhm.
that we need to follow.
I know we're kind of right up against time. I guess the other thing that's top of mind, and Manish brought this up in the chat this week, is, you know, we saw a couple of weeks where the 1% was breached in the Slay Trader weekly, I think, or maybe some of the dailies too. I don't pay as much attention to those, but and so, you know, when to just drop a trade, when to just exit. You know, you've already talked about this, Peter, but it's just probably worth underlining in moments like this where you have, oh man, you know, the market going up dramatically. You got the VIX low, and then, you know, you've got the 1% mark. You know, kind of right there where the market is, and it can feel like, oh man, you know, I gotta, it has to turn down, right? You know, but we've all experienced markets where it can stay irrational according to the math for a while, and so just sticking to your system and knowing when you're gonna just be a little bit more mechanical as opposed to emotional when it comes to exiting a losing position, I think, is really my point here.
Well, a couple of things okay, so we'll pass along a few pieces of a couple of nuggets of knowledge here. Do you remember when the run up in the index, in the S&P 500 index started? You don't have to give me an exact date.
It was
just give me
about,
sort of a,
yeah, it was like, I mean, it was just about a month ago, right? I think this has been, you know, we had that.
yeah, about a month
check
ago,
down.
right?
Yeah.
So end of March, early April. Do you
Yeah.
remember where the VIX? Do you remember what the VIX was at?
It was high.
What was it? Remember how high?
36.
It was in the 30s, wasn't it? Okay. At one point in time, I think I posted in one channel. I don't remember if it was in Slay Trader or not.
Your
Blind Squirrel.
Yeah.
Big run-ups in the index happen when the VIX is high.
Mm.
They don't happen when it's at 14.
Mm-hmm.
Okay. So this wasn't unexpected. Couple of other things that experience is taught. I don't trade zero DTE. I don't like it. Kim does. But zero DTE, you can run into issues like in a roundabout way where you just get clobbered because of trending days. trending days happen a lot more under the 0DTE regime than they used to, because retail piles in. They buy calls. That we see when we see a lot more. I've noticed, at least, that we see a lot more market up, VIX up, market down, VIX down days now than we ever have before 0DTE existed. That used to be a rare occurrence. Now they occur almost every week. You get, which means that divergence is starting to lose its meaning. I don't pay attention to it as much, especially if it's on a Monday, as what we used to. And a lot of this has to do with this new 0DTE regime, if you will. 0DTE has only been around since 2022, since about March of 2022, but it changed the way that options trade. Okay. I don't like to sell a lot of calls. If I sell calls, like I will, a way to think about the number of calls to sell is for every $200,000 of net liquidation value or a value you have in your account, you should have one call. So if you have a $400,000 account, you have two. If you have $1 million, you have no more than five calls total. This is SPX though. If you're doing cash covered position covered calls or something like that, well, then you don't want more than what your position size is and things such as that. But calls are a place where the market will trend, and part of that's because of 0DTE. People just push their position, they buy more and more and more. And it's from the 0DTE point of view, it becomes an inverse casino. That's how Avis, the stock Avis, went from just they put a short squeeze on it. A lot of large institutional traders or firms are short Avis stock. They believe it's going to go to zero. It's going to be bankrupt, just like Hertz did. Well, if the retail community on Reddit sees that, they start buying call options against it. And that causes the market makers to then have to buy the underlying. And you get this cyclical effect to where the thing goes crazy on the upside. That's harder to do on SPX, but it's not impossible. So we get a little bit more volatility in that regard. In terms of where to get out, I had a 27.75 call option on Friday. The market made it to 27.72. When the value of that option got to be about $1.75, I think, I simply moved it another week from Friday to next Friday and covered it 1-for-1 with cash. Okay. What it means is that I can't sell more call options because I have that one, if I follow my rule, but I can do that forever. I can keep going up forever because the market is not going to go up forever. And if it does, then my long SPX position makes money anyway. So it just means I can't sell more calls. So keep that rule in mind. Don't have more on the call side. We're going to talk a little bit later about the pricing differences between puts and calls. I treat calls completely different than I do puts. I will sell puts every single day. I will only sell calls when they meet my criteria on my sheet and whatnot, and then I don't sell a lot of them. Calls I look at as just extra money. It's not my bread and butter. Any other questions, guys?
Thanks.
Okay, we covered a lot of material today. We will pick this up from here next week. If you think of any any questions between now and next week, you can either ask them in the Blind Squirrel Trade on the Discord, or DM me, or just wait until the next time around and ask them then. But again, it's going to get more complicated from here. So just be prepared. I will send another set of invites. This one will have a recurring event. The one I did this week was only a single event. And we've had some more signups for this class since last week. So look for another email from me this week that has a new video conference link for it. Okay. Anything else, guys?
Thanks very much for taking the time, Peter.
No, thank you.
Thank you very much, Peter.
All right.
Yep. Thank you, Peter.
Y'all have a good weekend. Take care.
Guys.
You too.